Coming from NetPicks headquarters, it's the Day Trading Authority with Mark Soberman and Brian Short.
All right, hello, welcome traders. This is Mark Soberman with NetPicks, and welcome to another edition of the Day Trading Authority. Joining me again today is Brian Short. Are you with me, Brian Short?
I'm with you, Mark, and excited to be back and doing another edition.
Are you truly excited to be back to doing another edition?
Well, if you don't hear the excitement in my voice, it's because I am suffering from a little bit of a cold, but I am truly excited.
Got it. You get sick a lot, because I think in podcast number 1 you were sick as well.
My voice was pretty shot in podcast number 1. I said the same thing to my wife the other night. I said, oh, great, we got to do another one of these, and my voice is going to be kind of, iffy, but hey.
What can you do? Actually, they probably think it was somebody totally different in episode 1, and I should kind of used a whole different name here for you joining me today. But with that, enough of that. Let's go ahead and move on to why people probably are listening, and that's to talk about trading and day trading and things that have come up and come to mind. So we've been getting some great feedback on the first 2 podcasts, and if this is the first listen, you can definitely go back and listen to episode 1 and 2 and hear just how Brian sounded in episode 1. And the way you can do that is you can go on iTunes and you can actually subscribe to the podcast. So whenever we get around to doing another one, you automatically will have it pushed into your iTunes and onto your device if that's how you like to listen. You can also go to netpicks.com, netpicks.com/podcast, all lowercase, and that'll get you to a page where we also replay online, and you can also download the MP3s there as well. So whatever works for you, whether you like to listen to it on the go or at your computer, either way, we've got the different formats for you. And don't forget, if you're on iTunes, definitely leave us a review if you don't mind. If you're getting a lot out of this or learning a little bit of something each time, it's definitely good for Brian's ego, and it's his motivation to continue on if he sees those positive reviews. I know how you get, Brian.
Yep, I gotta have them.
There you go. Now, something that comes up a lot, we get asked, is what are you trading? There's always a lot of curiosity what we're involved in. Obviously, there's more choices out there than we kind of know what to do with, so sometimes people feel like if we're not trading a certain market, they question it or they wonder if it's no good for them, or maybe there's something wrong with it, and it's simply not the case. There's just almost so much bandwidth that you have as a trader, and there's only so much you can do at one time. And really, as a day trader, I kind of find when you've got about 2 markets going at once, you are pretty near capacity, and 3 is definitely pushing it if it's an active market. So you can imagine we have to make some choices based upon what works for us. One of the markets, not the only market, but one of the markets that I do personally like to trade is crude oil futures on a day trade basis. I don't personally swing trade it. It's not to say that it can't be or shouldn't be. It just doesn't work for me. And when I say doesn't work for me, it just sort of doesn't fit my personality and how I like to trade. But as a day trader, I am a big fan of crude oil futures. You probably need at least $7,500 in an account or more to safely trade a contract. I mean, your broker will probably be more than happy to go maybe less than that, depending upon the broker. But when you figure 2% risk, that's $150. Every tick is $10. So that kind of only allows about 15 ticks for a stop, which on a day trading time frames, that's probably pushing it a little bit. You may sometimes be even a touch above that. So that's why I say that's kind of like the borderline of acceptable. If you're below that, don't really bother with that market yet until you move on further. A couple little quick tips, just so you know. The one thing to always look out for is that weekly inventory report. It's typically on Wednesday at 10:30 New York time. But it trips you up because on days that there's a federal holiday in the U.S. on Monday, they almost always push to Thursday, and Thursday at 11. And I can't tell you how many times over the years I've forgotten that there was a holiday on Monday, and I have not traded on Wednesday for a certain reason, and I realized after the fact that, oops, I should have traded Wednesday because the report's actually on Thursday. So always check that economic calendar like we've told you in the past podcasts. One final thing, and then Brian will kind of jump in here and tell you what one of the markets he likes to trade that he would suggest you look at. At the end of this podcast, I'm going to give you a link where you can get a free guide to trading the crude oil futures. It's basically 7 tips to success in crude oil futures. Really good guide. It's free, which is the best price of all. And it gives you some of this insight, for instance, on the weekly inventory report, best time of day to start trading, best time of day to stop trading, and a whole host of other neat stuff. If you're at all interested in that market or want to learn more about it, hang in to the end, and we'll cover that. So, Brian, with that said, it's all you.
All right. Well, I've got 2 markets that I really like to trade, so I'm going to go with 2 instead of just a single.
So you have to beat me. You have to one-up me here.
I have to one-up you. That's exactly
all right. I have 2 more once you're done.
Okay. I've been a big fan of the metals for a long time. I've actually owned the physical metals, gold. I'm talking about gold and silver. Way back in early 2000, owned quite a bit of it, in fact. And that's the one way that I invested back then, more of a longer-term trade. But since then, I've done more intraday trading with gold and silver. And specifically, I like to start at 8 o'clock in the morning. That's about 20 minutes before the pit open. And go for 2 hours. And I do.
That's New York time, right, Brian? Sorry,
that is New York, yes.
Okay.
Thank you for that clarification. So that would be New York time. Both of those instruments have been very, very good as far as a lot of good price action, with the exception of January. January has been a little bit tricky in some of the markets, as price has contracted, volume has contracted to levels that are low, the lowest in the last 2 years. And so we've had to adjust how we look at things and how we trade a little bit, not going for as big a target. And that seems to be working well. And then once things will pick up again, obviously we'll stretch our stop and target out again. But again, those are my 2 favorite instruments to trade at this point, and I would encourage you to take a look at them and see if it might fit into your trading. The thing I like is I can get started early, 8 o'clock New York time, and be done by 10 o'clock, and I've got the rest of the day to do other things.
I would say too, Brian, that they should realize that silver, if you're trading the full-size contract, is going to take quite a bit more capital. I mean, you're probably talking $25,000 for a contract, even though your broker, right, will probably take less. It's just, 10 ticks is $500, and that's not a huge, or I should say 10 cents, which is 20 ticks. But that's, probably you need at least that much in a normal day trade, and that's $500. 2% means $25,000. Gold is going to be a lot more like crude oil, where 2% probably would be like that $7,500 to $10,000.
Exactly. That's a great point. I did forget to mention that. So.
And you know what? Sometimes the dollar amounts scare people away, and maybe it should, because really that's you want to be capitalized enough in trading. It doesn't mean you cannot day trade with less capital. These are just some markets that you're not going to want to bother with initially. There's certainly futures markets that you can start with 5,000, and there are forex markets that, well, not in the futures area, but in the forex, where you can even start with $1,000. I don't recommend typically going too much lower than that, but there are options available to you. All right, so appreciate that, Brian. So let's move on to our next topic. So every podcast, we like to discuss either a current event or a really great article that happens to be in our Trading Tips blog. The Trading Tips blog, if you're not familiar, is available at netpicks.com/trading, the little hyphen, and the word tips, plural, so trading-tips. And you can kind of see all of the various articles that are written by myself, by Brian, but even more importantly, by our crack trading coach team. And we have a great team that posts inside the trading blog. Once again, it's all free for you. And there's a lot of great stuff in there. And I kind of stumbled onto this when I hadn't actually been in there in about a week or so. And there's an article by Shane Daly, one of our coaches up in Canada. And the article is titled, and I really suggest you read this one. It's called Before You Jump Into Day Trading. In particular, if you have not yet jumped into day trading, right, this would be an article to definitely read. And what's interesting, even as I read it, I was like, wow, there's a lot of good top-level points here, even if you have been trading for a little while, in particular maybe if you haven't had the success that you're looking for. And I'm going to give you like a really quick sort of a skeleton rundown here of what's covered in there, but he really sort of takes you from the beginning, fundamental analysis versus technical analysis, and the recommendation is definitely to use technical trading systems if you want to be a day trader. His real point there is, as much as we all love to interpret economic news, and Brian and myself, when we're trading, we chat about a report and whether it was stronger or weaker than expected, but I can't tell you how many times personally I've been completely wrong with how the market reacts based upon the news. It tends to do exactly the opposite of what you think it'll do, and that has a lot to do with expectations. So with technical analysis, his point is, the belief is that everything is kind of cooked into price, and you've got this massive crowd mentality, and rather than you trying to be an economist, you can just sort of let the chart tell you what's going on. And there's a variety of indicators you can use: Fibonacci, stochastics, MACDs, on and on and on. Or you can certainly purchase a trading system that's fully developed, like the ones that NetPicks offers, where it'll come with indicators, but more importantly, all the rules that you need to use the indicators. Because it's not just good enough to have indicators; you have to have a whole rule set and a trade plan that goes along with that. But he kind of moves on to something that's always sort of near and dear to our hearts, which is backtesting. I know, Brian, you always talk a lot about the importance of backtesting.
Yeah, there's a lot of benefit that can be gained from that. First of all, you reinforce the method that you're looking to apply to your trading. And then secondly, it gives you a very good feel for how the method performs and what you can expect going forward. And so it's a very key and critical piece to the process that a lot of traders skip over. I mean, I understand we get excited when we see a new method. It's like that bright, shiny new toy that you want to get out and play with right away. And a lot of traders just dive right in. But backtesting really is an important key component. I would encourage every trader out there to take that exercise to heart and work through it.
And we should probably clarify when we say backtest, we don't mean you hit that button that does the automatic backtesting in a MetaTrader or a TradeStation. We literally mean it's like a walkthrough where you walk the chart through. Even better, if you kind of hit the little scroll bar like you were doing it in real time and record your trades and make decisions like you would in real time. I mean, there's always going to be the guy listening here who's got his arms folded saying, oh, backtesting doesn't work and it's not like real-time trading. And you're right. I mean, it's true. But if you can't do it in hypothetical backtesting walking through, you're certainly never going to be able to do it in real time, which kind of brings up the next point that Shane made, which is, you need to do a forward test before you really dive in there with, your hard-earned dollars. A forward test means you go live in the markets, and it could just be you're trading a demo brokerage account. It could mean you're trading a very small, tiny, account. Use a micro account in Forex, but you have to do something where truly you can't cheat, because what happens is, as much as you think you're not cheating, you don't intend to. All of us do this, even when we backtest. We tend to peek a little further ahead, or we don't even realize in our minds. We change our minds that, oh wait, I wouldn't have got in there. I would have actually adjusted my entry, and let me erase that loser. Right? You just do that. It's just, but when you're live, you can't do that. You can't cheat yourself, and obviously cheat the system. He then goes on to talk about something called positive expectancy, and this is a really important formula. It's probably not a great idea if I give it here because you almost want to see the article, but it has to do with you sort of just take your winning percentage and how much you make when you win, and then your losing percentage and how much you lose when you lose, and you come up with this number. And you want this to be really positive. The higher the better. And what happens is a lot of times people start trading, they think they have a winning system, and actually when you do that formula, it ends up being a negative number. And if it is, you got to stay away from that. You're going to lose money, guaranteed. And it's a really great number to look at. It's a number a lot of people don't look at in their trading. They look at the winning percentage. They see 85%, and they're like, I'm golden. And then they don't realize that the losers are a lot bigger than the winners, and a lot of things go into that. This formula will really kind of guide you on how solid your system is. I mean, you can have a 35% winning system, and you may have a brilliant positive expectancy, and a 90% winning system could be terrible, and that surprises people sometimes. So make sure you do that. And the final thing he ends up with is how important money management is. Certainly trade psychology, because that's going to be really tough for most people. But he definitely talks about, no matter how good your trading system is, you're going to blow it if you don't use just halfway responsible, risk management. I know, Brian, that's trade psychology and risk management is always near and dear to your heart.
Yeah, it's really two legs of the three-legged stool. If you want to think of it this way, there's three legs on a stool. The first leg is the method. That's the one area that most traders focus on, is the method they're going to approach the market with. And a lot of times the other two, risk and trade psychology, don't get any of the attention when they really should. All three get equal attention. And so if you think of it that way, and apply yourself accordingly, balancing all three of those will make for the ingredients to successful trading.
Yeah, I think that's definitely true. So again, my recommendation: read the whole article. I'm just sort of sketching some of the things. When I read it, I was like, yep, the whole way down. I was in complete agreement. So grab that on the Trading Tips blog from Shane Daly. He's got some other really nice articles on there. James Kessick also put some great ones on there. So it's a great free resource. You got to work at this stuff. I mean, I know all we do sometimes in the podcast is give you more work. Read this, go here, watch this video, listen to this interview. But that's the reality of trading. We're trying to make a lot of money. There is no push button profit system. So it's really important that you put in some of the time, and it's well worth it. And hopefully you're passionate about this, which is why you're listening, and this is really interesting and intriguing to you. If it's not, this is probably not a profession that's for you. It can probably save you a lot of time and a lot of effort and probably a lot of money along the way if this doesn't intrigue you.
Tales from the Stupid.
All right, so it is definitely time for Tales from the Stupid, as you heard. And in this case, Brian and myself, we try to have a bit of a little confession and talk about some really dumb things that we've done recently in our personal trading. We do this so you guys realize that we all do dumb things in trading. And, it's one kind of fun to laugh at it after the fact, but it's certainly not a lot of fun when you're actually doing it. But it's important to sort of address what you did wrong and fix the behavior for next time. So I can tell you, for me, the thing that I did recently here, and it was actually today, so it's still a little bit raw, my emotions about this, but I didn't pay attention to my trade plan on the Forex. I trade the Euro US dollar, and I trade from 8 a.m. New York time to 10 a.m. New York time, and I have a rule that I'm looking for typically max trades 3, and I want to do something I call power of quitting, which basically means I need to end positive, and it's something that we always teach. And I've got this cutoff at 10, and for whatever reason, it was kind of slow this morning, and I ended up with my first trade lost, and my second trade was a winner, so I was definitely taking a third trade. What I didn't realize is I took the third trade after my 10 o'clock cutoff because I was very distracted in the other markets that I trade. I mentioned crude oil futures, which happened to have the inventory report today, so I had 2 different times today I was trading at. I was also trading the Russell E-mini during the same time. Brian mentioned the metals that he trades, etc. So I had a lot going on, but no excuse. That's kind of why I blew it, but I literally missed the cutoff. And let me just ask you, how do you think that trade turned out? Did I make money on that trade? And the answer is always no. I mean, of course, it was a full stop out. The reason my cutoff is there at 10 a.m. is I know my odds go way down on my winning percentage. So I completely blew it. I basically just gave money to somebody else in the market by taking that trade. So the moral here is reread your trade plans. Make sure you kind of just go over some kind of mental checklist with yourself. No matter how many times you do the same thing, you think you have this thing nailed. It's amazing. After all this time, I can still make as basic of a mistake as that. So that's my tale from the stupid. Hopefully next time I won't have one for you and I'll be perfect. But Brian, I'm sure you've always got some for us.
Why would you say that? I mean,
I'm just saying because you want to. Just because you want to contribute. That's all.
Oh, okay. Well,
yeah.
actually,
so you didn't trade this week? Is that
unfortunately, I do have one, and
I knew it.
Yeah, and there's probably a theme here. We've probably mentioned this before, but it's important. And the message that I want to get across today is you have to eliminate distractions. And in the last few days of trading, I don't remember exactly the day, but it was a couple days ago. I trade from 8 to 10. And my daughter happened to be home. She was late going to school that day. I think there was a delay. And she came barging into my office, and right in the middle of a trade that I needed to pay attention to. And she had something that was important that she needed to talk to me about, but the point there is I really didn't. It was an inopportune time. I needed to make a key critical decision on a trade, and it was a little bit stressful going back and forth with her. My point there is eliminate those distractions. If you have to put a note on the outside of your door that says, trading in session, like on air, you don't interrupt type thing, then you need to do that. And the other distractions that are out there too that can cause problems, when the market's slow, the temptation is to multitask and do other things, try to maximize your time. Let me just kind of suggest you don't do that. I had a situation this morning where we had 2 trades in silver that the setup printed, and I had like a split second to get that order in, and by the time I put the order in one case, it had popped through the price and then back up, and we had to make a decision on what to do and through to target very quickly. In the second case, it popped through my entry, filled us, and to target within seconds. And so again, eliminating those distractions, paying attention to the chart is key, because there will be times when the action picks up and goes very quickly, and you want to make sure you have everything in your favor, that you're using your method the way it should be used, and you don't want there to be mistakes. That's the bottom line. So eliminate those distractions, whatever they might be. I've listed a couple this morning, and resist the temptation to multitask.
Now, would you say locking your children in a closet while you're trading, would that eliminate the problem?
Did you hear me say that?
I'm just asking. It's just a question.
I don't think I could recommend that. I'm not sure what agency would be at my front door if I condoned that, so probably not.
Okay, I was just curious. So the other thing, if you don't want to lock your kids up in a closet, is you could, of course, lock your door. That would always be an option as well.
I could.
Okay, just saying. Yeah, I'm in total agreement with that. The only other thing that probably bothers me about this is I actually remember that trading question where your daughter barged in and we lost some money. So when is she going to send me that $500?
I'll talk to her about that tonight.
Because you were good. You kind of covered up. You actually never said that it was your daughter. You protected your family there. But now in this confessional,
now you know.
Come clean.
Because of this interview, now you know.
Okay. All right. Okay. I'm going to collect. I'm sending an invoice. Okay. So now our, I guess, more favorite part of this is when we can actually talk about our genius, some of the things that we do potentially that were actually smart, not so stupid.
Genius.
And for me personally, Brian mentioned this in the beginning. He talked a lot about we're recording this. It's in January 2012, and I realize some people sometimes come back to podcasts 6 months later, so we do our best not to make anything dated in these. So you can always benefit no matter when you listen. But at this time, we're kind of in this cycle where volatility and trading range has gone down, from literally probably October was great, and November was pretty good, and it started to go down into December that you expect. But everybody always thinks, oh, January, New Year, it's going to go crazy. And it's been interesting almost every year. The first few weeks of January tends to be the exact opposite, though I fully expect now it to start moving and start clicking in. We start to get quarterly estimates and things start to happen that are more interesting. But we use range bars a lot, and I don't really have, just not the perfect format here to teach about range bars, but they're basically fixed size bars. So you can imagine if you're using technical trading systems and all your bars on a chart are the same size, and suddenly the range of the market you're trading is cut in half, something's got to give, and usually what gives is your profits, and that's definitely something that we've seen. So what we do is we always make sure that our trade systems are dynamic. What I mean by that is as the trading range and the volatility goes down, the size of the range bars that I use goes down. So if I'm trading crude oil futures and back in November, December, I'm using bars that are, let's say, 10 cents or 11 cents in length, right now I've got them down to 7 or 8 cents, basically to behave the exact same way that they were when we developed the system, whether it was months ago or years ago. That's really important to do. And I know a lot of you don't use range bars, maybe you use time intervals, but if you're using 1-minute charts, 5-minute charts, and I'm going to tell you I don't like those for day trading, but if you do, you can only imagine more than likely your targets are way too big, and your stops are probably, in this case, more than likely too big as well, and you need to tune those up because the markets aren't going to go to the distance that they've been going. So I recommend people use something called average true range, ATR. It's in virtually every charting platform. At the very least, put ATR on your daily charts of the markets you're trading and see, is ATR going up or is it going down? That's a really good measure to you of whether you should really consider raising targets and stops or lowering targets and stops. And you have to start getting to the point where your trade system is dynamic. Otherwise, what's going to happen is you're going to have a couple good months and then it's going to basically implode on you. This happens all the time with trade systems. So that's my genius. It's really been the thing that's kind of helped us get fine-tuned here in January. If we weren't doing that, it would be a complete mess.
All right, I take it I'm up next.
Yes, you are.
All right.
We want to hear your genius. We didn't hear anything, so I wasn't sure if that meant you didn't have anything.
Well, I do have something that we're actually pretty excited to talk about. And Mark and I both have been looking at a different way of analyzing price flow and the volatility of that flow to trade the markets. And so we're in the very beginning stages of looking at that. And so I would encourage you maybe to do some digging if you're listening to this, and maybe by the time you listen to it, we'll have more information. But at this point, I'm just going to give you a teaser and say that it's something that will be coming in the next few months from us, and we're very excited about a potential approach to the market that measures price flow, and you get in and out of the market based on that. No indicators. It's strictly on who's buying, who's selling, and what we found is that can give you an edge in the market, basically, and a different tool in your trading toolbox. So we're really excited about that possibility, and going to be doing some more research, and we'll get more information out to everybody very, very soon.
Yeah, because we're very visual-based traders. We like to have things on the chart. I like to be able to see colors, see places to get in and get out. It's much easier when you're having to respond in real time, like when Brian was mentioning the craziness in silver this morning. I mean, if it's not visual and you got to do a bunch of other stuff to try to figure out what's happening, it's so stressful anyway when you're trading. So this is all about making that whole order flow, who's buying, who's selling, be completely visual on the chart, so you no longer have to sit there and try to somehow figure out, who's on the bid, who's on the ask. Very cool. So it's a great tease, and we'll have more for you soon on that. All right, so this portion of the podcast, we like to sort of get our guest interview, and we're going to have an excerpt here from a longer interview that we did with Anne-Marie Baiynd. She's the author of The Trading Book, A Complete Solution to Mastering Technical Systems and Trading Psychology. I read the whole book. It's very, very good. It's a nice real primer with some definitely hard-hitting, here's the technical indicators I use, here's the markets I use, here's how I approach the markets, which is great. But then she also does a really nice job of sort of, talking a lot about the other things that you have to incorporate into your trading, things that we always talk about, right? Till we're all almost tired of hearing it, but it's true. Trading discipline, trade psychology, money management, kind of the hard stuff in trading, but it's really important. So it's a real good overall from a successful trader, of her story, of what she went through, and we basically have a part of the interview coming up, and then of course you can hear the rest of the interview if you just go to our Trading Tips blog. We've got the full replay there as well. So with that, Brian, I guess let's go ahead and cue the interview. Got it. Now I know you're primarily a technical trader, and if I understood correctly, some of the major indicators that you use are the exponential moving average, the simple moving average. I know you talk a lot about moving average crossovers, and I think it was Bollinger Bands, and you use Fibonacci a lot. Does that still kind of make up the Anne-Marie trading system?
It does. what I've had to do, to clean the charts up a little bit since people watch me trade all day, it just gets a little messy for them if they're newer. So I will leave the Bollinger Bands off and then, focus on them. Frankly, price is so important that you can work with the fibs. Here are the primary things that I use. If I'm looking at super short time frames, I will look at the 50 and the 200 simple moving averages. And I love the stochastic momentum index. I think it's a fantastic indicator. Not a whole lot of platforms have it, but Thinkorswim does. And it's a very, very good indicator of what's on the horizon. And here's the thing. If a moving average is flat, and I see my price drifting further away from that moving average, it's got to bounce into it. So I'm always looking for that relative area of support, which I'm going to find with my fib, and I'm going to know, hey, listen, I'm coming up to test that 50 today, right? At least once a day, sometimes twice, we test the 200 on the 5. And so those two moving averages, nice and easy, just so long as we have those parameters of, okay, where's relative support and resistance, those are the things you really need only to focus on definitively. And so, short answer, yes, those are still the core things that I use. Maybe Bollinger Band a little bit less, stochastic momentum index a little bit more. It really depends on the day. If I look at the stochastic and it's not behaving well, or it's sitting in a neutral zone, I'm not going to mess with it at all.
Sure. I mean, one thing you point out in the book is that, trading is not cookie cutter, and a lot of people try to come into it. That's really what they want. I think I've got like the quote, you say, the day is never as simple as the if-then statement. If you're looking for that kind of roadmap in trading, your search will be exhausting, never-ending, and oh, by the way, an exercise in futility. So it sort of sounds like you are you adapt to the day, to what the chart is showing on that given day. I mean, you've got your core indicators, of course, in your core system, but it sounds like you have to be flexible day to day.
That is very true, and I think that is the most difficult thing for folks, because it seems to have so many moving parts. They want, see, in the end, we all like things to be stable, right? We don't want the friend that's a Looney Tune that does things we go, okay, where did that come from? We want things to be stable. We want our chairs always to work when we sit in them. We want our computers to work. And so we sort of force that mentality into the trading space, where really it's like a river full of fish. They're not always going to sit in the same place. Well, that's not exactly true. If you're a trout fisherman, you're going to know that they sit in a certain place all the time. But you know what I mean. Generally, they're going to be here, there, or wherever. And you've got to say, well, wait a second. What's the wind? Is it overcast? And I am a big fisherman, which is why I'm using this analogy. So you've got to be a little bit more flexible in terms of what you're looking at, and so many of us just don't know what we're looking at that seems almost impossible to do.
Right. I mean, I know you point out how important the slope is in trading, especially if you're doing any kind of momentum based trading. I guess that has, it's the same thing, being able to look at a market, determine that the slope of the move up or down isn't there, and even though your indicators might be firing a trade, because they're not going to stop firing trades, I guess
Correct.
Pulling back and not being in the market is something you need to do, but obviously quite difficult for people.
Exactly. That's really true. And you've actually stopped on a point that is incredible. We think that because we look at the markets and because we look at the charts that we have to be in a trade, and that is just simply not true.
Yeah, I mean, I think people feel like, hey, I'm trading from 8 to 10. That's what I'm here for. I'm supposed to have 5 trades. No matter what the market's doing, even if FOMC is about to come out or whatever and it's not moving, I'm going to get my profits. And unfortunately, it doesn't tend to work that way as much as you want it to. With the Fibonacci's, I know that's very key for you in trying to sort of determine what's next to happen in the structure of the market. And I remember you mentioned there were a few key levels, and you pointed out some percentages. I think you said like the 100% level. And the 200% level are almost always at least temporary reversal points. Then you also mentioned like your golden ratio, the 61.8. I know we've got some Fib people, so maybe talk about this a bit. So kind of what your favorites are.
Sure. For Fibs, here's something very interesting. if you take a look at the ZB, which is a 30-year Treasury bond futures, right? You'll notice that it really pays attention to a 50% fib, which is why I say, hey, listen, focus on a stock, take a look at it, understand it, because it's going to have a trading personality. Based on all the algorithms that are trading that, they're in pockets, right? So the people that trade in the ZB aren't necessarily trading Google, right? And so there's a different kind of temperament associated with that. That being said, overall, here's how market formations work. If something is in a trend and it's in the middle of a pullback, if it pulls back lightly, it will pull back to 38.2 and then begin to move forward again. If that 38.2 level holds and it begins to bounce, you know that the trend that you're moving in is very strong. The deeper the retracement levels, the weaker the overall trend is, or the more conflicted the traders are in that particular chart. So you can see that in terms of saying, all right, well, I'm in a bit of a conflicted chart. It's retracing 78.6% every single time. So I'm going to have to be careful about where I put that stop level. So it's about paying attention to what's happening in the formation specifically. So let's say we're looking at Google right now. Google's in a very important space. It broke out over that 618 a few days ago, and it's continuing to power forward. It's using a 61.8 retracement level because it's doing so well moving forward. That's the standard, okay, I'm going to take a breath to here and move forward. There's a very specific pattern called the ABCD pattern. A lot of folks use it in Forex, but I find it works tremendously well in the general market, and it assumes a 61.8 pullback and then a 1618 projection from the initial wave. And so when we look for that, everything's nice and structured. So if we are fortunate enough to see something pull back to that 61.8, we see it's in an uptrend, we don't see anything breaking down underneath, we can project out to that 1618, which I love. Now if I'm working with the futures, we have the Globex high and low, and as we move out through the day, here's something very interesting. Happens 95% of the time. If we come into the open within 2 points of the Globex high or the Globex low, we will rapidly accelerate away from it, either in the positive way or the negative way, right? It's going to move. So watch those moving averages and then watch those fibs associated with the Globex high-low. If it projects over, like it breaks out of the Globex high, it's going to come back and retest, more than likely. Sometimes it takes 2 hours to do that, and so you can chase it out. But sometimes it'll do it in 15 minutes, and you can bounce right back. It'll go into the 127.2. If it holds 127.2, it's going into the 1618. Clockwork. Day, 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 day. Now the problem is the retracement levels that we've been forced to stomach over the last weeks, they are so long and the wicks are so hard and so heavy that it's almost like a bunch of stop hunters are out there looking to blow us out, which luckily I use mental stops, so that doesn't normally get me until, you know, the mental stop really does kill me because I'm having to chase it out of the trade because it's just gone crazy in the other direction. But those are the kinds of things that I look for. But in the futures, 127.2, 1618. In the general trending stocks, I'll look for that 61.8 and 161.8.
And I guess that's why, like you mentioned earlier, it's really important to get to know a limited set of markets because you're sort of describing some behaviors that these markets seem to follow on a regular basis, and I'm sure that comes through observation and you sticking with these certain markets.
Very true.
One thing that I noticed you talked about quite a bit, and probably some of it has to do with the ability to sort of create some structure in the markets, maybe with the Fibonacci, is you do a lot of scaling in and scaling out. I think you mentioned that you don't typically go in with full margin when you're initially establishing a position, and you seem to actually even try to sort of sell into some strength on a buy and then rebuy it on a pullback. So I mean, is that still the philosophy you follow? And would you say you're a scale in, scale out type trader?
Absolutely, I am. Absolutely, I am. Here's the reason. My goal, because I learned how to lose a lot of money, my goal is, hey, listen, first and foremost, how can you minimize your risk and maximize your profit? And again, that's all around framing the trade, getting your fibs in the right space, and so on and so forth. But for me, depending on how many conflicting signals I might have sitting around, or how much overhead resistance is sitting, I will say, okay, I'm going to go half size or I'm going to go quarter size. When it gets into a particular space, if I've gone half size and it starts looking a little weak, I'll go back down to quarter size, clean profit off the top. Right there, my money's out of the market and I'm sitting in that one space. If it fails and it comes into support, I'm out flat instead of down for the most part. If it bounces, what I've done is give up an opportunity cost of having twice the size, because as my original position, which was initially half size, I gave up a little bit of that, but now that it's holding steady, I can add back to the position. And once it gets into a formation event where I see the crest, I go, okay, I'm going to get out. It's time to pull back, and then I'm going to wait for that floor. Now, Google, typical example this morning. I'm doing the pre-market report. I go, listen, Google is going to run today. It's going to run, and so what we have to do is realize that it's going to go up easily into that 634 level, and what we want to see is we want to see it come back into maybe the 15-minute low or yesterday's high, fill a little of that gap, and then we'll go in. Well, I had to reboot my system. I came in 3 candlesticks later. It's already blown out to my end target, 635. And so I look at it 636 and I go, all right, you're just going to have to sit and wait on this one because it's going to come back, and it's going to come back to test that 50 on the 5 because stocks do that. It was way too extended. So I sat there for 2 hours, literally, almost 2 hours, maybe an hour and 40 minutes before it came into the 50 on the 5, and I said, all right, I'm going in, and took it to the 632 level because I was getting ready to come in here. Would have left part of it on as I see it come into 634. That's what I want to see. And if it holds that level, it's going to go, you know, back up to 636 and then continue moving forward. So, yeah.
Yeah, I think, you know, in the NEPICS world, we call them in our systems, you know, add-on trades. We have re-entry trades, and then we have something called get Bob trades, which is basically just get back on board. And so definitely big believers in that as well. It's almost like you're asking the market to prove itself before you're, you know, kind of willing to go in full bore. But at the same time, like you mentioned, I think you also talk a little bit about trailing stops and how you're not a huge fan, I think I read that right,
yes,
of trailing stops, more of a scale in, scale out. I guess what's the, what did trailing stops ever do to offend you?
Well, here's the thing about the trailing stop. Now, long ago, a couple years back, maybe 2009, 2010, the trailing stop wasn't that bad. But we live in an environment where the market is so volatile that if you've got a trailing stop, you're sure to get blown out of your trade. Trailing stops are arbitrary, and real stops that work are based on significant lines of support and resistance. So if you want to use something arbitrary to make your trades, then you're actually saying, no, sure, I am all for arbitrary results. But if you are not for arbitrary results, then you don't need to use something arbitrary like a trailing stop. Use a stop that makes sense. So many folks use stops that go, well, you know, 75 cents, that's it. Well, does that actually make sense? What's the low of the candlestick that broke the level? Which is what I always say. Hey, listen, you broke a level, look at the low of the candlestick that created the break. Look at the low of the wave that created the move. How strong is it? Where is it? Your stop needs to be above it or below it. you can't have something arbitrary like trailing stops. And now we choose arbitrary trailing stops because we don't understand the nature of our stock maybe, or it's just plain easier. And easier never really points to better results. Something harder in terms of analysis and using all the information that's being presented to you is really always going to reap the greater reward.
Yeah, I think we totally agree with that because we always teach, using dynamic stops, dynamic targets. I haven't really ever met somebody who uses, stubborn targets and stubborn stops who's ever successful, in the long run. If you say always on my TF trades, I'm going to go for 2 points target, 1.5 points risk, it could work for a while, but it never holds up.
No, it never does. It never does. It's actually, that is just terrible. I hear people saying that all the time. I really have to go, okay, how's that work for you? Because it really doesn't. It does not prove itself out to work.
All right, so that was very informative. I really enjoyed that interview. Hope you guys got a lot out of it. We got a lot of feedback when we did that. Some people were talking about how, I remember a couple that we got, like, geez, I could, sit there and just learn and listen from her all day. So I hope you got something out of it. I would really recommend you listen to the entire interview. It's well worth it, and consider looking into that book as well. Just, hop on Amazon.com, the trading book, Complete Solution to Mastering Technical Systems and Trading Psychology. And yes, I'm reading that. I have not memorized that. So, Brian, we're at the end of the podcast, but before we go, we've got a couple quick things. We always like to answer a question or two from some of our loyal listeners, and we've got one today from Raphael J., and it was a really long-winded question. He went on and on and on, and the question was Forex or futures? So, and it's a great question. It's very difficult maybe to easily answer this. But I'm going to tell people, I think, look, if you have less than $5,000, you're going to be a Forex trader. That's where you need to be. And you can learn all kinds of great technical trading skills in the Forex markets, and they will carry over into futures and vice versa. So there's nothing at all against moving from one to the other or even doing both. So I always tell people, look, the money is going to sort of dictate a little bit to you where you're going to start.
I would agree with that, Mark. The Forex is a great place to, I think, for a new trader to kind of cut your teeth. After you've gone through the exercise of doing your back test, doing your at least 25 practice trades, even if you have a lot of money and can invest in futures, the Forex market is a good place, I think, to, like I said, cut your teeth and learn a little bit, because you can go in with very small leverage, very small risk per trade, and prove to yourself that you can be successful, and then graduate from there, to higher risk, and then graduate maybe to some of the futures contracts that we trade, crude, gold, and then even up, higher up to silver from there.
Yeah, and don't forget you can do Forex futures. And I'm going to say that while Forex is easier to get going, it requires less capital, you can get free trading platforms like MetaTrader 4, and the data feed is free. That's all great stuff. You're not going to get any of that in futures. In futures, you're paying for your platform, paying for your data, paying exchange fees. Yuck. I mean, all that's bigger minimum to start. So that's what I think is so brilliant about Forex these days, is that it's a great learning environment. However, I'm actually going to tell you, when it gets down to actually trading those markets, futures trading is easier. And I hate to use the word easy, but what I mean by that is you don't have this fixed bid-ask spread issue that you have on Forex. The liquidity gets a little weird on Forex. There's no centralized pricing. You're a lot more reliant upon the server at your broker than you are the big exchange servers like the Chicago Merc that rarely, if ever, go down. There's a lot of additional issues on Forex trading that make it more complicated, I really feel, when it comes to the actual mechanics of the trade and the executions than there is on futures. So that's kind of sort of, in a way, like the catch-22, I guess. It requires more capital and more money and more costs, but when it comes down to it, futures many times can actually be easier to trade. You'll a lot of times just end up having less issues. But those are the pros and cons, I think, behind both. And I think, let your capital sort of dictate how you start. And remember, you can always move up, like Brian says, and you can move on to other things. So great question, Raphael. Please, by all means, send in your questions to us. We're always, want to hear that. podcast@netpicks.com, and we'll try to answer yours next time. A couple quick announcements to let you know. If you want to hear the next author interview, we do these live interviews. When I'm recording this, we have one coming up on February 7th, 2012. Just go to netpicks.com/interview. And you can sign up. We've got Denise Shull, and her book is Market Mind Games. Very popular author. Should be a really fascinating interview. I'm looking forward to reading the book and also asking her a bunch of questions. And by all means, sign up for that and join us live. If you're listening to this after February, again, just come to our site, opt in, etc. We always have the replays for you if you missed it. And I also want to give you the website where you can get the free crude oil futures trading report. You just need to go to tradecrudeoil.net. So just make sure it's a .net, tradecrudeoil.net. You'll see on the right-hand side there's a little place you put in your name, you put in your email, and they'll blast it out to you. It's a really nice PDF, 7 really great tips to start trading crude oil futures. Stuff that's been learned over a number of years, and there are some real, things that'll save you a lot of time if you're at all interested in those markets. So with that, Brian, I really appreciate it. I think another good episode, lots of great information. Any closing remarks?
No, just I hope this was beneficial for those listening, and that you can walk away with at least one gold nugget that you can implement into your own trading. So good trading to everybody.
Great. Thanks, Brian, and we'll talk to you all again next time.